If you've ever felt overwhelmed hearing terms like index funds, mutual funds, hedge funds, or ETFs thrown around in finance conversations, you're not alone. These investment vehicles are the building blocks of wealth, but understanding how to utilize them is where the real power lies. In this video, we're unlocking the secrets of the money game with a focus on financial education, personal finance, and the strategies that legends like Warren Buffett use for long-term success in the stock market. Whether you're exploring ETF investing, just starting your journey in investing for beginners, or fine-tuning your portfolio management skills, this guide was made for you. We'll break down what each fund is, how they work, and how to choose the right ones based on your goals, risk tolerance, and asset allocation. Welcome to Trailblazers Mindset, where wealth builders come to get inspired. Let's dive in. Firstly, let's start with the question, what is a fund? Let's break it down. A fund is simply a collection of money from multiple investors, combined to invest in a wide variety of assets, like stocks, bonds, real estate, or even other investment vehicles. Picture this. You and 4 friends are planning a cross-country road trip. Instead of each person driving alone, burning gas, handling maps, and paying tolls solo, you all chip in for one car. Together, you cover more ground, split costs, and share the experience. Plus, with a designated driver who knows the best routes, your trip becomes way easier and more efficient. A fund works the same way. Instead of picking individual investments on your own, which can be confusing and high risk, a professional manager or algorithm drives the vehicle, deciding where to go and what to invest in. You just ride along and benefit from the journey. Whether it's a mutual fund, ETF, or index fund, the idea is the same. Pool your money, diversify your investments, and reduce risk, all while giving you a shot at steady growth and passive income. Now let's dive into the types of funds. 1. Index funds. An index fund is a type of investment fund that mirrors the performance of a specific market index, like the S&P 500, which tracks 500 of the biggest, most successful companies in America. Instead of trying to outsmart the market, and often failing, index funds ride with it, capturing its steady growth over time. Let's discuss why index funds are considered a game changer. Consider the following. 1. Low fees. We're talking rock-bottom expense ratios, as low as 0.02%, so more of your money stays invested. 2. Built-in diversification. With just one fund, you own tiny pieces of hundreds of companies, from Apple to Amazon. 3. Simplicity. No need to be a Wall Street genius. Set it up, keep contributing, and let time do the heavy lifting. If you're serious about personal finance, financial freedom, or investing for beginners, this is your foundation. Think of index funds as your financial autopilot, low stress, high potential, and a long-term path toward real wealth. One quick note. You can't trade index funds like stocks throughout the day. They're priced once after the market closes. Now let's discuss mutual funds. Imagine you're going on a road trip. With index funds, you're on cruise control, letting the map guide you. But with mutual funds, you've hired a professional driver to take the wheel, someone who claims they can get you there faster by avoiding traffic and taking shortcuts. That driver is the fund manager. A mutual fund pools money from many investors, just like index funds. But the difference is that instead of passively following a market index, mutual funds are actively managed. Fund managers research companies, analyze trends, and handpick stocks they believe will outperform the market. The upside for the fund include 1. Human expertise. If you believe in a specific manager's strategy or insight, mutual funds give you access to that experience. 2. Specialized access. Some mutual funds focus on niche sectors, international markets, or strategies not available in index funds. And the downside are 1. Higher fees. Active management often comes with expense ratios of 0.5% to 1.5%, which eat into returns over time. 2. Inconsistent performance. Many mutual funds fail to consistently beat the market, especially after fees. Please note that like index funds, mutual funds are priced once per day after the market closes. No intraday trading here. So, is it worth paying extra for a driver? That depends on your goals and objectives. For some investors, mutual funds are a trusted option for tailored, hands-on investing. But remember, even the best driver can hit traffic. Choose wisely and always align your investments with your financial education, personal finance goals, and long-term vision. Before we continue, if you find value in this video, please hit the subscribe button to join our growing community. We appreciate your support. Thank you. Next is hedge funds, the VIP lounge of investing. Think of hedge funds like the Formula One of the investing world. High speed, high stakes, and only for those who can afford the ticket. These aren't your average funds. Hedge funds are exclusive, often reserved for accredited investors. individuals with high incomes or significant assets who are allowed to play in riskier territory. Unlike index funds, ETFs, or mutual funds, hedge funds don't just buy and hold stocks. They employ advanced strategies such as 1. Short selling, which involves betting against a company. 2. Leveraging, which involves borrowing money to amplify gains. Third, and derivatives, which are complex contracts tied to assets. All these strategies are designed to chase bigger returns in both bull and bear markets. The cost of playing big are 1. A 2% annual management fee, just to be in the game. 2. A 20% performance fee. If they make you money, they keep a hefty cut. Although the cost seems high, the upside is that if the strategy works, returns can be astronomical. Some hedge funds have made billions, even during market crashes. The major downside to note is that these funds are less regulated, more volatile, and less transparent than traditional investments. Therefore, hedge funds demand serious risk management, deep pockets, and nerves of steel. They're not built for the everyday investor, but they showcase the upper limits of what's possible in the stock market. Now my favorite, ETFs, the best of both worlds. If you're just getting started in the stock market, ETFs or exchange-traded funds might be your perfect match. They combine the diversification and simplicity of index funds with the real-time trading power of stocks. Think of them as the every person's investment vehicle, low cost, flexible, and easy to understand. So what exactly is an ETF? It's a basket of investments like stocks, bonds, or commodities that you can buy and sell on the stock exchange, just like a regular stock. The beauty is that you get exposure to dozens or even hundreds of assets in one single purchase. That's serious risk management with minimal effort. Now let's discuss why most savvy investors consider ETFs a game changer. 1. Low fees. Most ETFs charge between 0.03% and 0.75%, which means more of your money stays invested and working for you. 2. Instant liquidity. Buy and sell at any time during market hours. 3. Diversified choices. From the S&P 500 to dividend stocks, international markets, or real estate, there's an ETF for almost every investment goal. Unlike mutual funds, which are only traded once a day and may charge high management fees, or hedge funds, which are exclusive and high risk, ETFs offer accessibility and affordability to everyday investors. They are an ideal tool for investing for beginners who want financial education and personal finance tools that work. If you're focused on financial freedom, ETF investing could be the smartest, simplest way to get there. Like most everyday investors, index funds and ETFs were my golden ticket when I started, and that's because they offer what really matters: low fees, broad diversification, steady performance, and most importantly, peace of mind. No guesswork, no stress, just consistent progress. And if you're just starting out, ETF investing is one of the most beginner-friendly, powerful tools in personal finance. The real magic happens when you start early, stay consistent, and keep it simple. Even Warren Buffett says most investors are better off in low-cost index funds. That's not just advice, it's a proven path to wealth management that works. If you're serious about building real wealth, then consider this channel as your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth together. If you are interested in how savvy investors are turning $20 a day into $1.4 million, check out our video on that topic. The link is in the description. Please note that we are not financial advisors. This content is for informational purposes only. Click on the next video on your screen. We appreciate your support. Thank you.